Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with my good friend Richard Duncan. How are you doing today, Richard?
Very well, Kirk. Thank you for having me back on.
Yeah, well, Richard's a friend. He's been on the show a few times. Great content. We wanted to bring him back, especially because of what's going on in the markets. We thought, who better to explain this than Richard? So, for the listeners who haven't heard you before, Richard, tell us a little bit about your background.
Okay, I have spent all of my career really living and working in Asia. I moved out to Hong Kong when I was 25 and started working as a securities analyst, and have worked in Hong Kong and Singapore and Thailand a few times each, uh, as an analyst initially, and an economist, a strategist. I worked at the World Bank in Washington for a couple of years, and I was the head of global investment strategy for ABN AMRO Asset Management in London for a few years, looking at all the asset classes globally. And along the way, I've written 4 books. The most recent one is called The Money Revolution: How to Finance the Next American Century. And my business now is MacroWatch. MacroWatch is a video newsletter that I sell on a subscription basis. So I've been doing that for 10 years.
Nice, nice. Well, glad to have you back on the show. Love your content. So let's dive right in here. So, Richard, the world has changed a lot in the last, well, in the last 100 years, but the world's changed a lot in the last 2 years. And I think that most people don't realize that we've kind of gone through this paradigm shift. So, can you give us a little of the background of what's going on in the world, what's going on in the U.S., and just from kind of like a macroeconomic standpoint, and then we can kind of dive into the details.
Right. Well, you are totally right. We have undergone extraordinary changes in the last, well, since 2008, but beginning a little bit before that, if you will, when the Bretton Woods system broke down in 1971, that really rewrote all the rules of how the economy works on a global level. It meant that the central banks suddenly were free to create as much money as they dared to help finance government debt. So we've seen government debt skyrocket. In 1980, U.S. government debt was $900 billion. By the time Reagan and Bush left office, it had quadrupled to $4 trillion, and now it's $31 trillion. Meanwhile, the U.S. trade deficit has blown out from effectively zero. Last year, the current account deficit was almost $1 trillion. And this has meant that the rest of the world, by exporting to the U.S. Roughly $20 trillion since 1980, the trade surplus, that's allowed the rest of the world to grow enormously faster than they would have been able to do otherwise, resulting in things like the rise of China, turning China from a very poor developed country into what is now the second most powerful country in the world, superpower, on nipping at our heels. So we truly, in my lifetime, have gone through just phenomenal economic changes that I think, a generation ago they couldn't have conceived of. And then it's all accelerated just since 2008. That financial crisis resulted in the Fed taking its total assets from $1 trillion in 2007 up to $4.5 trillion through money creation by the end of 2014. And no sooner had that crisis calmed down than COVID began. And again, the Fed doubled its assets from roughly $4.5 trillion to nearly $9 trillion. So this was paper money creation on a scale that just seemed inconceivable before 2008. And the first time, 2008, we had hardly any inflation at all. Inflation peaked at 3.8%, the CPI. But this time, it was a very different story. Inflation peaked at 9% and now has come back down to 3% at the headline CPI level. So it wasn't as transitory, it wasn't as quickly transitory as the Fed had expected it to be, but it seems to have now come back down to really quite a low level. And the Fed has tightened. The last time we spoke, the Fed had just hiked interest rates once. That was at the end of March last year. And now the federal funds rate is above 5%. And it looks like we're in for one more hike at the end of July. So, and the Fed is now trying to reverse quantitative easing rather than creating money through quantitative easing and pumping it into the financial markets. They're now destroying money at the rate of $95 billion a month and sucking it out of the financial markets. So this has really been just an extraordinary period to be an economist and to watch these changes unfold with disasters that were entirely unanticipated, and then policy responses that were undreamt of, just to see how it would all play out and the impact that it's had on asset prices. So it's been a fascinating time.
So maybe you can kind of quickly explain, because I don't want to get lost too much in the economics lingo, because people start tuning out because no one's interested in listening to economists, even though it's important. What does quantitative tightening mean?
Well, so quantitative tightening is the exact opposite of quantitative easing. With quantitative easing, the Fed buys government bonds and it pays for them by creating new money and buying those bonds. And when the government spends that money, it pumps that money into the financial system and into the economy. And it tends to make asset prices go up, because the more money or the more liquidity there is being pumped into the financial markets, it's not surprising that all the stocks and property and commodity prices, everything goes up together. It lifts all the boats. Quantitative tightening is the exact opposite. Here, they're effectively selling the bonds that they've already bought. And when they take payment on those bonds, they get the money back. But they don't just keep this money in a safe somewhere. When the Fed gets the money, it just evaporates, it disappears. And it sucks $95 billion a month out of the financial markets. And over time, $95 billion a month adds up. That's $1.1 trillion a year. So even if we're just thinking over the next 6 months, it seems to me that it's possible, between quantitative tightening and some other things that are going on, the amount of liquidity in the financial markets could be reduced by perhaps as much as $1 trillion, which would create very serious headwinds for the financial markets and the stock market in particular.
So just to kind of clear this up. So basically, quantitative easing was causing the markets to go up, which if you make the logical deduction, quantitative tightening should cause the markets to go down, right?
That's exactly right. All other things being equal, which of course they never are, but yes.
Right. So if that's the case, then I mean, to me, it seems like the markets aren't necessarily responding to that in the way that you would expect. So what's going on with the markets? I mean, if they're pulling money out of the system, if they're basically destroying money instead of printing it, the markets are close to all-time highs. They don't seem to care.
Well, a few things are going on here. First, they started this quantitative tightening in June, and they went on up until the Silicon Valley Bank crisis started. And from the time they started until the 1st of March with the Silicon Valley Bank, they had destroyed $600 billion. But then Silicon Valley Bank blew up, and the Fed, within 3 weeks, they created $400 billion. So they reversed 60% of quantitative tightening in just 3 weeks. So there was a reprieve for the markets, if you will. But they did carry on afterwards with quantitative tightening, and we're now back to where we were at the 1st of March. They have destroyed $600 billion from the peak, and they're going to continue destroying money. Now, another thing that is happening is that the AI revolution. came at us out of the blue starting in November. And that has driven up the share prices of the Magnificent Seven. And those stocks apparently are responsible for nearly all of the appreciation in the stock market since then. So that's the second thing. I mean, everyone is so wildly enthusiastic, and probably with good cause, about what it means for companies like all the obvious ones. If you look at, particularly at a 10-year time horizon, these companies, the Magnificent Seven, they could be on value at multiples, several multiples, many multiples of what they are at the moment, if we're looking 10 years out. I mean, of course, who knows? But it truly does seem to be the most extraordinary technological revolution of our lifetimes, probably greater than even the internet itself. So that's another factor. Now, the third thing that I think is much more important, perhaps, than very many people have realized is this. The stimulus was so extraordinary during COVID. The government sent 3 rounds of stimulus checks out to the American public. And as a result of that, this is reflected in the savings of the American public. And savings, you can say, are reflected in the amount of bank deposits that there are in the country. So if you look at the total amount of bank deposits in the United States, going back as long as you choose, it's a steady line upward. Year after year, they increase steadily until COVID starts. And from February 2020, over the next 24 months to February 2022, total commercial bank deposits jumped by 35%, by nearly $5 trillion in just 2 years. Nothing like that had ever happened before. And so this increase in savings, or money that is in the economy, I think is the main reason that the economy itself has been so strong. Most economists, including myself, had expected and believed that we would go into a recession very quickly soon after the Fed started hiking interest rates and quantitative tightening. But we haven't. The economy is still on pretty firm ground, and the unemployment rate is 3.6%, near a 50-year low. So I think this amount of money that the government injected directly into people's bank accounts was such a massive amount of money so quickly that it's almost as though the sort of amount of money the government would have had to spend during a very significant war. For instance, in World War II, the government spent massive amounts of money during the war, and that ended the Great Depression, which had been lingering on for 10 years. And afterwards, after World War II ended, we had 20 years of prosperity during the 50s and most of the 60s. And a lot of that was driven by all of the money and investment that occurred during World War II and then rebuilding after the war ended in Europe. So I think that this money that was injected into the economy through the COVID stimulus has been powering the economy to an extent much greater than everyone had anticipated that it would. And that's one thing that is uncertain. How much longer is this going to linger? Many people have the impression that once the individuals go out and consume, then the savings rate will drop back down and will return to normal. But that's not right. If one individual goes out and spends all of his or her savings, that doesn't make those savings disappear. Someone else gets that money as income, and they deposit it into their bank account. So the savings are still there. The only way the money is going to disappear is as the Fed destroys it through quantitative tightening at the rate of now $95 billion a month.
So, all right. So the some of the metrics I've been seeing, which interestingly enough, if you look at the savings rate, it was really high during COVID, right? Because people got all that cash, and it subsequently bottomed out somewhere around August of last year, depending on maybe June of last year. And then it's kind of bumped up. The savings rate has started to climb again. But the credit card balances have certainly gone up. So is this kind of an example of one of those, kind of a tale of two cities? You've got the people that are on the margins are getting squeezed because of inflation, and you've got the people who are business owners or wealthier seem to be doing okay, or what's the I'm curious about what the outcome is for all this, because it doesn't seem good, but for whatever reason we still keep plugging along like everything's okay in the economy.
I think what you said is right. The lower income individuals would have been the first to spend the money they received from the stimulus checks. And after a few rounds, most of that money would have ended up in the bank accounts of the wealthiest individuals. But that doesn't mean that it's just going to sit there in a big safe as cash. At the very least, it's going to be invested in the financial markets. And it has been invested in the financial markets. And that's one of the reasons they've been so strong as they have been this year.
So let me ask you this, because we've got, this episode was done in July. So, from when it actually comes out, some things may have happened, but, right now we're at a 5.25% Fed funds rate. They're talking about raising it one or two more times. Where do you see them going with that? Because there's this big question in my mind that I want to lay out. But where do you see them going with that? We can kind of fill it in.
So it looks like they will hike at least one more time at the end of July, on July 26th. And at that point, they will probably skip the next meeting. And what happens after that will depend on the incoming data. Now, a week or so ago, the CPI number came out and it was only 3%, which was lower than people had expected. But that's the headline number. The core numbers were higher than that. The core CPI was 4.6%. 4.8%. And more importantly, the numbers that the Fed look at most closely it's called the Personal Consumption Expenditure Price Index. And the core price index on that core PCE price index is still 4.6%. So that's very high. The Fed's target is 2%. And it's been very sticky at that level. It's been bouncing up off that level for the last 6 months or so. So it's not certain that the next hike will be the last, but there's a reasonable chance that it will be. It will just depend on the incoming data. But I wouldn't think that it seems unlikely that there'll be more than two more rate hikes. So we'll be peaking out probably at the most at a federal funds rate of just above 5.5%. And then I still believe it's likely that the U.S. will go into recession. And once it does go into recession, it won't be long before then people will lose their jobs. There'll be less demand. Meanwhile, supply has been increasing for most things. So inflation will come down quickly at that point, and the Fed will begin cutting the federal funds rate next year again, and perhaps cutting them quite sharply, which the financial markets will be very pleased about that once it does begin to happen.
All right. So I've got something to lay out for you. I want to get your thoughts. So, prior to this, like a year ago when the Fed was starting to raise rates to fight inflation, they raised rates from effectively 0 to currently 5.25, right? And the idea was to fight inflation. So they raised rates. Now, coincidentally, the inflation went down, but there's usually a lag. There wasn't a lag this time. It was immediate. So that to me would illustrate the fact that raising rates didn't cause inflation to drop. Even though they're correlated, it didn't seem causative because there always seems to be a lag. However, the Fed seemed determined to squash inflation, right? Now they have a different problem. So now you have the Fed funds rate, which is high. You have the CPI, which is 3%. It could even drop more. My thesis was if real estate starts to drop, you could hit a 0% CPI by the end of the year. It's not high probability, but it's possible if housing starts to drop. So my question is you get a lower CPI, which could go to 0 or even below if they really push it. And the Fed has high rates, which should push deflation, not inflation, oddly enough. So what does the Fed do, right? Because if they drop rates it cause another spike of inflation, or which they don't want, right? They're trying to squash it now, or do they keep pushing it and push us into deflation, right? Because typically they lower rates when we go into recession, right? We go into recession, they lower rates, it stimulates the economy and bumps us out of it. But what if this time they don't? What if we go into recession and they keep rates high because they're trying to squash inflation? So how do they handle that? It seems like they're in kind of a bit of a corner, and there's no really right answer for them. So what do you think they would do?
So I think let's look back just a few years first. And as you said, they have hiked the interest rates and the inflation's already come down. So there didn't seem to be a connection between the hiking and the inflation rates coming down. But I think at the same time, we should also look back a little further and ask ourselves, how much was the increase in the Fed's money creation responsible for the inflation? How much did the Fed really cause the inflation? Well, I think the answer to that is that it contributed to the inflationary pressures. But the inflationary pressures, the Fed created even more money in percent terms at the end of 2008 during that crisis. And the highest rate of inflation we had then was 3.8% in 2011. And by early 2015, we had a few months of deflation again. What was different this time is COVID. Everyone was locked down. They couldn't go outside and go to restaurants, or go to the movies or anything like that. So they ordered jogging machines and iPads and iPhones that were mostly all made in Asia. But the Asian factories were locked down because of COVID. So suddenly there was a spike in demand, and the American consumers had lots of money to spend because of the big stimulus checks they received from the government. But the supply side was all snarled up. And so that was, in my opinion, the main cause for the spike in inflation. And then once there was, after 9 months or so of that, or a year of that, then Russia invades Ukraine. And suddenly we get a big spike in oil prices and in food prices directly related to that. Now, had the Fed not created a lot of money during COVID, allowing the government to send out the stimulus checks, then no, we wouldn't have had inflation. We would have had a depression, and we would have had deflation. So it is undeniable that the Fed played a role in financing this inflation that we got. But I think that more than just the money creation, it was the supply chain bottlenecks and the war that were mostly responsible for the inflation. And what we've seen now, explaining why the inflation is coming down, is these supply chain bottlenecks have been worked out. There are no longer shortages of semiconductors as there were a year and a half ago. In fact, now there's a glut of semiconductors. And commodity prices have been coming down. Oil was what, $140 a barrel? Now it's $80 a barrel. So those disruptions caused by COVID and the war explain largely why the inflation rate has come down to 3% now, at least at the headline level. So looking ahead, it is likely that the higher rates of interest will slow the economy down, because already the housing market is taking a hit. People can't move because they can't get rid of their current house if they wanted to, because they would have to get a new mortgage at a much higher rate than their existing mortgage. And as time goes by, I mean, we're already seeing home prices fall. That's probably going to get worse. And as the Fed hikes again, that's going to make consumer credit more expensive. And these people who have already spent their stimulus savings, they're out of money. And as you mentioned, they're running up credit card bills with very high interest rates attached to those credit card debts. So it is likely that the economy will go into recession and cause inflation to fall even further. It may take a little longer than I wouldn't expect it to keep dropping straight down the way it did seem to do last month. But when the economy goes into recession and when inflation moves back to the Fed's 2% inflation target and then perhaps moves below it or even to zero, as you suggested, then the Fed's going to start cutting rates very aggressively again. And when they cut rates very aggressively, and they'll have to stop quantitative tightening. The last time they did quantitative tightening, they tried to reverse it, starting, I think it was 2017 they started, but by September of 2019, they had taken enough liquidity out of the financial markets that it caused a crisis in the repos market. And that forced them to not only stop the quantitative tightening, but immediately they had to reverse it and relaunch quantitative easing, even before COVID started. So it's very likely that not only will the Fed have to stop hiking interest rates, they will have to begin cutting rates probably aggressively next year. And at some point, if the Fed continues destroying money through quantitative tightening at the rate of $95 billion a month, 6 months from now or 9 months from now, we're going to be back in another repo market crisis situation or something similar. There'll be some sort of corner of the financial market that blows up and forces the Fed to stop destroying money and perhaps even creating money again. And when that occurs, that whatever crisis that has blown up in the financial markets, if the Fed creates enough money, that will stop that crisis and it will cause the injection of new money. If the Fed relaunches money creation and quantitative easing again, that will cause the financial markets to go up again. So we're in a cycle of the Fed creating money and creating asset price inflation. Then they try to destroy some of the money that they've created. That ultimately ends in a financial sector crisis. And then they have to create more money again to stop that financial sector crisis. And when they create more money, that causes the asset prices to go up again. So we're probably going to be in sort of a Groundhog Day scenario, seeing the same cycle play out a few more times at least into the foreseeable future.
Yeah, no, that makes a lot of sense. So one thing that kind of comes to mind is this market has confused a lot of people, right? Like you see all this data and you look at the last, 20, 30 years and what's happened, and you would naturally deduce certain inputs would lead to certain outputs. And yet, the markets have been not doing that, right? Like you'd think that raising interest rates should affect housing, yet interest rates climbed rapidly last year and housing climbed 10%, the median home price, right? And the Fed is raising rates. It should push us into recession, yet we haven't seen signs of a recession. Maybe some small signs, but nothing significant. Low unemployment, all of that. So when I look at the bigger picture, I look at it and say, well, what's going on? Like, why is the outcome not reflective of the inputs and what the Fed is trying to do?
Well, so I think the main thing is the point that I raised earlier about the amount of stimulus was so extraordinarily large, resulting in this 35% jump in deposits in the banking system, that's the main factor that's carried the economy through. But now there are some other positives that are coming through. I think quite significantly, the three major pieces of legislation that were passed by the previous Congress, the Infrastructure and Jobs Act, the Chips and Science Act, and the Inflation Reduction Act, those acts are going to funnel hundreds of billions of dollars into new investments in the United States. I think we're already beginning to see the impact of that, and that is going to accelerate from here. I mean, for instance, the Chips and Science Act, I think that was extraordinarily an important and very good thing for our country. The act allocates $380 billion of investment into new industries and technologies, with $50 billion of that going into very badly needed manufacturing facilities for semiconductors inside the United States, and the rest of the $380 billion going into investments in research and development into things like artificial intelligence, quantum computing, robotics, genetic engineering, biotech, nanotech, neurosciences, and renewable energies. So that was a big step forward that the United States really needed, because the government hasn't been investing very much in research and development for decades. And it's enabled China to overtake the United States in the amount that it invests in research and development at an alarming rate. And if something's not done, China is going to become the undisputed global superpower, economically, technologically, and therefore militarily. And we just can't allow that to happen. And so this Chips and Science Act was a very important development, and one that I really, the whole theme of my book, The Money Revolution, was advocating a very large-scale government finance investment in new industries and technologies. So I was delighted to see that. And then the Inflation Reduction Act, which came at the very end of the last Congress, it wasn't clear for a number of months exactly what was going to happen, but it now is clear that that's going to result in hundreds of billions of dollars being invested in the United States in new industries that will result in the construction of new factories that we've already started to see, and more employment in those industries and in building those factories. So I think that's been a major plus for the economy, that's supporting the economy and is probably going to continue supporting the economy. And then just the run up in the stock market, of course, this year, thanks to the Magnificent Seven and the AI revolution, that's created wealth. And the wealth supports consumption, and consumption is nearly 70% of the economy. So that's supported the economy. So those are just some of the factors. And one other thing that has helped support the global economy is the U.S. trade deficit, more technically the current account deficit. Essentially, the Americans importing more than they export. The current account deficit hit an all-time record high last year of almost $1 trillion. And that was very helpful for the rest of the world, because it allowed the rest of the world to manufacture and sell to the United States $1 trillion more in goods than they could have done otherwise, employing millions of people who wouldn't have been employed otherwise. But it was also beneficial to the United States, because when these people in the other countries, they sell their goods in the US, they get paid in dollars, they take their dollars back to China, mostly, increasingly to Vietnam, and to other trade surplus countries. And what do the people there do with those dollars? Well, if they want to earn any interest on them, and of course they do, they have to invest those dollars in US dollar-denominated assets, like government bonds or Fannie and Freddie bonds, or even into stocks and other corporate bonds. And that's another reason. So every country's, they say, the fact is, every country's balance of payments must balance. That means the bigger the trade deficit is, the more money will come back into the United States as capital inflows and foreign direct investment. The two are mirror images of each other. So those capital inflows from abroad have supported economic growth in the US by pushing up asset prices and pushing up government bond prices and holding bond yields lower than they would have been otherwise.
So yeah, so those are certainly kind of the bullish. I want to get into kind of the bullish and the bearish arguments here. You started talking a lot about the bullish arguments, which I think certainly is shows that the economy could go a lot higher. Let's talk about the bearish side a little bit, just to give it balance, because I think it's we're in a place where it's confusing, right? And where the direction's going to go is anybody's guess at this point. And I've taken a soft poll from people I know, and you get people on both sides, and no one's really confident about their side. So let's talk a little about the bearish side. So we got a lot of new programs coming. That's great. That's certainly pushing technology. Artificial intelligence is there, which I would argue that actually, before we get into the bearish side, the AI revolution certainly is going to be really interesting. I was listening to a conversation between two people in the crypto world, and they talked about basically how the US is stymieing innovation in the crypto space completely. Like they're totally against it. The regulators are against it. So everyone's moving offshore. And so we could lose a whole technological sector, a new technological sector to everywhere else in the world but the US with blockchain. So I don't know if you have any thoughts on that before we get into the bearish side, but to me, it was a really fascinating look into our typical innovation is to let people innovate, and we have this culture of innovation, and yet with blockchain, it seems as if we're trying to stymie that.
Well, I think it's important to distinguish between blockchain and cryptocurrencies. Cryptocurrencies use blockchain, but anyone can use blockchain. You can trade dollars on blockchain or use blockchain to trace your transactions around the world in any currency you choose. It's just they're two separate things. The cryptos trade on the back of a blockchain. I try to avoid discussing cryptos. People become so emotional about it in both directions. I try to avoid the topic, so I will bow out of that discussion. I don't want to make enemies on either side, because I want both sides to agree that we need to have more investment in new industries and technologies, in real industries and technologies that actually produce goods and services and technological breakthroughs that make the world obviously and demonstrably better, like investments in quantum computing and genetic engineering and biotech and so forth. So I'm not, I don't really think the regulation of cryptos will hold the country back in any meaningful way whatsoever.
Okay. Yeah, I was just curious because they seem to have it seems to be a different approach to it than they've taken to other industries. But all right, so let's move on. We don't want to we don't want to cause people to get triggered over conversation about crypto or blockchain. So all right, so we talked about some of the bullish side, AI, the Infrastructure and Jobs Act, the Chips and Science Act, the Inflation Reduction Act, like all those big programs that were instituted. Now let's talk about the bear side. Like what are some things that people should be thinking about when they're looking at the direction of the economy and the market?
So for me, one of perhaps the most important thing to understand about the economy in our 21st century is that credit growth drives economic growth. Since 1952, or let me say between 1950 and the crisis of 2008, every time that total credit, and this is adjusted for inflation, every time total credit adjusted for inflation grew by less than 2%, the economy went into recession. That happened 9 times without exception. And the recession didn't end until there was another big surge of credit expansion. And credit growth became so rapid, it grew much more quickly than the economy. So the amount of credit relative to the size of the economy increased from about 130% of GDP in 1950 to 370% of GDP by 2008. Credit growth was the main driver of economic growth. And so I focus with MacroWatch. One of the main themes of MacroWatch is we've got to monitor credit growth very carefully because credit growth drives economic growth. And what we're seeing on the credit growth side is something very unusual now. Credit growth has been less than 2% of GDP. I mean, the credit growth has not only been less than 2%, it's actually been negative for the last 6 quarters, and we still haven't gone into recession. So this is a very big anomaly. Now, this is the biggest round of inflation we've seen, of course, since the 1980s. But with credit so weak, that's been the main thing that has led me to believe that we would have a recession. And it's still below 2% credit growth. In fact, it's still negative. Credit is contracting when you adjust it for inflation. To me, that's a very big bearish signal that the economy is going to go into recession. But it's been like this now for 8 quarters, and we haven't gone into recession yet. But it is still weak. And for me, that is one of the most important bearish factors about the outlook for the economy. Credit growth is too weak to drive the economy now. And if we revert to what has been the norm since 1950, then this strongly suggests that the US will go into recession. So that's, in my book, that is a very big bearish signal. And we've already talked about liquidity being tightened through quantitative tightening. Now, the problem there for the economy is if liquidity becomes so tight that it creates a big stock market sell-off again, the way that it did in 2019, then that will destroy wealth. And less wealth will mean less consumption. Less consumption will mean less economic growth and recession. So that's another big worry. Then we have to think about the resumption of the student loan repayments, which will begin kicking in October this year. It's not quite certain how soon that will hit, because apparently people won't be deemed to be in default on their student loans for up to 12 months. So maybe they just won't even think about repaying their loans for the first 12 months. Some will, some won't, I suppose. But a lot of people are going to have a lot less money to spend once they have to start repaying their student loans. And that's going to act as a drag on the economy, and perhaps a significant one. And then the Fed is likely to hike again at the end of July, and perhaps even once more after that. That is very likely to put more downward pressure on home prices. Not a year and a half ago, home prices were rising by 20% year on year. Now they're contracting year on year, and they're probably going to keep contracting. And that's going to cause a lot of problems for people who had hoped that they would continue to appreciate. So that's going to be a problem, lower home prices, resulting in less wealth and less confidence. And then finally, I suppose on the bearish side, especially for the stock market, is that asset prices are really very, very inflated by historic norms. And there's one really good measure, I think, to look at. And this is something that I call the wealth to income ratio. It takes all the wealth of all the Americans, in other words, all their assets minus all their liabilities. That's called household sector net worth, or in other words, wealth. Take that wealth and divide it by disposable personal income. So it's wealth to income. And that gives you this ratio that I call the wealth to income ratio. Now, this gives us some gauge of how expensive asset prices are relative to income. The average for this wealth to income ratio going back to 1950 has been 550%. It hit an all-time high during the NASDAQ bubble in 2000. It went up to 620. And then that bubble popped and it went back to 550 when all the asset prices fell. Then during the property bubble, it went up to a new all-time high of 660. And then that property bubble popped in 2008 and it went back to its long-term average of 550. Well, now this wealth to income ratio has gone up to 760. I mean, it's way above where it was in the property bubble. And what that's telling us, and that was driven largely by the appreciation in home prices, but also by the big run up in the stock market. And so what if this does go back to its long-term average, that would wipe out, trillions and trillions of dollars of wealth and be a very damaging blow to the US economy. So that's something that I worry about, this very elevated wealth to income ratio, much higher than it's ever been before, especially with interest rates so high, likely to move higher, and especially with quantitative tightening, just sucking out $95 billion every month from the financial markets. It's telling us that the financial markets are quite vulnerable to a very significant correction if the slightest thing goes wrong.
So I want to ask you a final question in the interest of time, because we're going to have to wrap it up here. I always love our conversations and I wish we could talk longer. So one question that comes up over and over is housing, right? So last year, housing, even though the dynamics, the markets were down, median home price was up 10% last year. And the affordability of housing basically what the cost right now, as of today, compared to 2021, it's going to cost you 2 times the amount of what it would have cost you in 21 to own the same house for the same price. Not for the same price, but for whatever the median home price is then and now. It's going to cost you twice as much. So if it costs you $2,500 a month in payments, now it costs you $5,000 a month payments if you were to buy the same house on the market today. So that doesn't seem to have caused a hiccup in the housing market. A lot of people claim it's supply and demand issue. That may be true, but to me, if you can't afford a house, you can't afford a house. So kind of walk me through the thinking on this. Why hasn't real estate been affected by this change when, you know, like I said, some people claim supply and demand, some people claim, you know, affordability. I don't know where you fall on that.
Yeah, so Kirk, I bet you're probably more an expert on U.S. homes than I am, but if you look at the 20 city Case-Shiller price index for homes, I think that index peaked in probably the middle of last year, and now it's negative year on year. And I would, you know, prices may have gone up 10% last year, but they could easily be down 10% this year, and that could easily not be the bottom either, because they went up so incredibly during the pandemic. What was it, 40% in 2 years or something outrageous.
Yeah.
And if we have a recession, then people, you know, will lose their jobs. If the past is any guide, they'll lose their jobs by the millions. And some of these people may not be able to make their mortgage payments, and we might see a lot of new homes start hitting the market, causing downward pressure on home prices. So I think, you know, I think home prices have further to fall, and perhaps quite a bit further to fall.
Okay. No, cool. I was just curious in your thoughts. So, Richard, I appreciate you coming on the show and sharing your wisdom with us. I always value it. In a world where not much is clear, it's a breath of fresh air. So, thank you for coming on the show again. Where can people find more about you if they want to follow you and continue to hear some of your wisdom?
Great. Well, thank you, Kirk, for having me back on. People can find me on my website at Richard Duncan Economics. That's richardduncaneconomics.com. And if they would like to take a look at my MacroWatch, let me tell you a bit about MacroWatch. MacroWatch is a video newsletter. Every 2 weeks, I publish a new video discussing something important happening in the global economy. It's effectively me making a PowerPoint presentation. They're typically 20 minutes long. Maybe they have 40 or 50 slides that can be downloaded. And I discuss something important happening in the economy, what the Fed is doing, what the government's doing, what's happening globally, and how all of those things are likely to impact the stock market, bond prices, home prices, commodity prices, and currencies. So I hope your listeners will visit the website, richardduncaneconomics.com, and take a look at MacroWatch. And if they'd like to subscribe, I'd like to offer them a 50% subscription discount to MacroWatch. Hit the subscribe button, and you'll be prompted to put in a discount coupon code. If you use the discount coupon code TREE, you can subscribe at a 50% discount. And I think your listeners will find this very affordable. So I hope they'll take a look and check out the website anyway, and consider that. So thank you for letting me mention that. And thank you for having me back on. It's always a pleasure talking with you.
Great. Well, thanks again, Richard. Appreciate you coming on the show. We'll stay in touch, listeners. That's where you can find more about Richard. And Richard, thank you again.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Richard. Always appreciate him coming on the show. He's one of my favorite macro economists. He really has a good finger on the pulse of what's going on in the world. Obviously, there's a ton going on in the world right now, whether it's from wars or, inflation, global inflation, globalization, all these big macro trends are going on. So I always appreciate his insight. Now we're getting into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how are you?
Good. Glad to have you back. And we also have our very own Tim Baker. Hey, Tim.
Hey, Kirk. Good morning.
Hey, glad to have you back. So let's dive right in. So, Phil, what were some of your takeaways from the interview?
So first, I'll say that Richard was pretty bearish about the economic outlook. He talked a lot about some data related to recession. I know we have the inverted yield curve where we have long-term rates, interest rates are less than short-term rates, which typically is a sign of recession. But then he talked about there was a wealth to income ratio that he had that's at a really high level. So he was definitely on the bearish side, to put it mildly, I thought.
Okay, yeah, that's fair. That's a fair assessment. What about you, Tim? What were some of your takeaways?
So as a guy who spent the first 12 years of my life as a bond guy, I used to work on bond trading desks and I also did corporate bond research. We're all bearish. They always say the bond guys and the economists are the most negative guys in the room. So that's just always par for the course. The one thing that jumped out at me, and I know Phil already kind of addressed this, was the inverted yield curve has historically been pretty accurate in predicting recessions. But there have been a time or two, and I apologize, I don't have them off the top of my head, when the yield curve inverted and we didn't wind up going into a recession. The other issue that I think is important to point out that after the yield curve inverted, we actually technically did go into a recession in 2022. It was just never called so by the National Bureau of Economic Research because the economy, the jobs data, wage growth, all of that stuff was too strong. So I'm sure everybody's aware a recession is technically 2 consecutive quarters of negative GDP growth, but that's such a not small, but it's such a small piece of the pieces that the Federal Reserve will look at in their policy. And just the jobs market was too strong to technically call it a recession. So there are some that are now saying the inverted yield curve this go around may not be as meaningful as it has in the past because we did have a recession last year that we ignored.
Yeah, it's a great point, and it's very interesting because we all look at correlations, not causations, and people look at it and say inverted yield curve, that's going to cause a recession, and I think probably back in history there was a case to be made for that because an inverted yield curve caused the banks to lose money, which means they're not lending, which leads to less credit growth and yada yada yada, and would lead on to a recession. And now the world is so complex that I'm not sure that is a direct or maybe even any causation anymore. I think it's more of just a correlation that people abide by, but it's a very interesting one for sure. Now, one thing I wanted to bring up because since we recorded this show a few weeks ago, as of last night, Fitch, which is one of the credit agencies, lowered the credit rating of the U.S. government debt with a stern warning that you should not be borrowing any more money. So they moved it from AAA rated, which is the highest rating, down to AA plus, which is a very slight drop, but still it was significant in the sense that it was more of a psychological like warning more than having a huge impact. So Phil, what are your thoughts on this downgrade? You know, what are the effects, and how should people be thinking about it?
So the first thing is, I mean, it's a minor downgrade. It's not that big. It also, from what I saw, related to the machinations that went through around raising the debt ceiling and all that, and they're playing a lot of games with that stuff. If it was a serious problem, like we'd have to see interest rates on treasuries, which are thought of as safe investments, they'd have to start to go up, because the amount of the safety that we have that goes with them. If there's less safety, then rates are going to go up because there's a corresponding change there. So that's one thing. But overall, I mean, I don't think that this is that big a deal, because it's just a minor change. But if it was to continue to go in that direction, obviously it would become much more meaningful.
Yeah, I agree. Tim, what about you? What are some of your thoughts?
Yeah, again, as a former bond guy, I've got a number of thoughts on this. Number one, I'm just looking at an update on the market, and it looks like 10-year yields are kind of backing up a little bit. 10 years at a 4.11. This morning, they were holding pretty steady. The first thing I would say to folks is this is obviously not new. The S&P 500. Standard and Poor's did this back in 2011 over basically the same issue, which was, you guys keep bringing everybody to the brink of disaster by going through these debt ceiling negotiations and holding everybody captive with them. So S&P actually did the same thing down to a AA plus back in 2011. The other interesting thing that was brought up this morning was that Fitch, as some may or may not know, Fitch actually put the U.S. on negative credit watch a couple of months ago, back when we were dealing with these debt ceiling negotiations. And by the way, a very sympathetic ear. I do think it's crazy that we keep going through these debt ceiling negotiations and then we basically just punt it. And this one I thought was really interesting because we didn't raise the debt ceiling, we just suspended it. So we really just said like, all right, we're just not going to deal with it for now. And so we'll see what happens in January of 2025 when the suspension is over. But in any event, I do think that I would agree with you guys. It's a pretty small downgrade. We've been through it before. We still have very solid credit ratings. One of the things that Fitch mentioned was not just the debt ceiling stuff, but also they gave a pretty stern warning about a recession and what that would mean for tax receipts for the government if there's layoffs, so on and so forth. So I do worry about those things for sure. But again, I'm, me, Kirk, and Phil, like, I'm not going to sit here and predict things. I'm not going to say we're going into a devastating recession. And by the way, if there are layoffs, that's not necessarily an awful thing. We're at very, very low unemployment. So I posted on a couple of social media places this morning, and I just put, now we'll see how much it matters, ... It felt a little bit knee jerk and, well, delayed knee jerk from Fitch.
Yeah, it's interesting because, as you said, I mean, other agencies have already downgraded them. I think, were they the last one to downgrade? Is there anybody else who
No,
has
so
them as
Moody's,
AAA?
I was actually just looking at that. Moody's still has them as a AAA. And there are now 1, 2, 3, 4, 5, 6, 7, 8, 9 countries. Well, no, make that 7 countries in the world that are AAA across the board.
Interesting. I'm curious, who are those countries? You want to read them off? Because I'm curious for reference.
So the one I actually knew off the top, or the two I knew off the top of my head, were Germany and Switzerland. But it's also Denmark, Netherlands, Norway, Sweden, and Australia. And then you get to the two that are right there with us, or that are right there with us with some mix of AA and their AAA, and those are Canada, New Zealand, Austria, and Finland.
Interesting. Yeah, we'll have what I found to
The
be most
Scandinavian countries seem to be holding up pretty well.
they do, and they're, if you look at some of their numbers, they always tend to be high. They're like the CAPE ratios and what have you of those countries always tend to be high, and they still tend to do well. What I find interesting most about the downgrade from the announcement was the lack of interest in the market. So I had a lot of people who were watching all night, and I was actually out doing stuff, so I missed the downgrade until this morning. And I had friends who were up all night watching the international market to see what happened, and it was like crickets. It was like, wait, did anyone see the news, or is everybody in the Hamptons right now? And maybe Moody's is in the Hamptons, and they're going to wait till the fall to come back and downgrade the U.S.
Yeah, I love it.
Or maybe they're just trying to be the outlier, just to be different. Who knows? But either way, I don't know how anybody looks at our financials and says, "Oh yeah, they'll be solvent in 20 years." Like,
well, and it's funny. I think the age-old joke is it's not necessarily that the U.S. will be solvent. It's just if we're not, we'll just make more money.
Well, I think so here's the interesting issue. So that's 100% true. The real issue is, we're still the cleanest dirty shirt. It's not like other countries are any better. Like, we all have the same problems. Even the countries are still AAA. I mean, Germany's in good shape. Switzerland's always in good shape. But, for the most part, most of the developed countries are in tough shape. You know what's a funny country that's actually in pretty good shape? What do you think the biggest surprise is for in terms of countries for their, I guess you call it their balance sheet, their outstanding debt? Russia. Russia has one of the lowest sovereign debt outstanding of different countries in comparison. Like, I saw Saudi Arabia, I think, is also low, but Russia's really low. And I was looking through the economists list when they do this at the end of each issue. At the back, they have all this financial data, and I saw it. I'm like, wow, Russia's really has a very small amount of sovereign debt. And I think if I had to guess, it would be because of the past crisis. They said, you know what, we're not going to let the U.S. leverage us with our debt, so it's really low. And I can't stipulate that, but that's so I've heard. Anyway,
you say it was relative to GDP.
I think so. I don't want to misstate that, but I think if you go to the economists, maybe one of you guys can look this up while I'm bantering here. But I know on the Economist site they have this, and I'll have to pull it up if you guys are chatting here. But basically, the stat is consistent with every other country in the world. Comparatively, it's very low, and it might be compared to GDP or something like that. But anyway. Point being is we're in tough shape, but every other country out there has the same problem. Debt to GDP of Japan is off the charts. They seem to be managing. The U.S. debt to GDP keeps climbing, and we seem to be okay, although every other country is climbing as well. So it's a global problem, which leads me to believe that in my estimation, if I had to guess, the global solution is a global debt jubilee, where everybody just lights their debt on fire at the same time. Because if one country does it, the whole world has a problem. If everybody does it together, it's not so much of a problem. You're just kind of moving the bar for, it's kind of like the economic principle of, oh, we should raise minimum wage. Well, yeah, raising minimum wage doesn't do anything, because that just causes price to go up, which means it's still going to be more expensive for the people on minimum wage. So it doesn't actually have a positive impact in the way that people think. It does, but overall, it also raises the bar for everybody else, and I think it's the same problem with high debt globally. I do want to get into one aspect that we talked about with Richard, which is the bullish case versus the bearish case, which I think is really important at this juncture, because you can make a case for either side, and I'd love to hear kind of the bullish side first, because I think you guys are probably more bullish than bearish. But what are your thoughts, Phil? What do you think we go from here on the bullish side? Like, what looks good to you?
So we can start with the fact that we have employment is strong. We have the economy still growing. I mean, the recent GDP numbers showed 2.4% growth. So the economy is still growing. That's definitely a positive. I said employment earnings season has been pretty good. So some of the key factors that you want to think about from a market perspective are going in the right direction. We have the interest rate environment, I mean, I know where it was compared to now, it's changed a lot, but the interest rate environment is still relatively favorable. I mean, I think that, you know, if you go back to when we had really high inflation in the late 70s and into the early 80s, I mean, interest rates were much, much higher. So there's still borrowing capacity, things like that. So if I look at it from those perspectives, you know, those are all positives, and inflation is coming down, right? And a lot of the, as he talked about during the interview, a lot of some of the things that caused the inflation were somewhat short-term in nature because they were driven by a lot of the supply chain issues that we had and things like that. So if I think about it from that perspective, things look all right. And so that kind of supports the bullish case.
Okay, good. What about you, Tim? What are some of your thoughts for the bullish case?
Yeah, and I would just echo. I mean, I think all of those comments were made this morning. I saw an interview with somebody that was basically like, Fitch put them on negative watch 2 months ago, and you would argue that everything's gotten better since then. So what compelled them to do a downgrade when things have actually gotten better since they put them on negative credit watch? So, the bullish case is, I think Phil laid out like what everybody's looking at, which is unemployment is low, wage growth is good, not keeping up with inflation, but the two are kind of starting to converge as inflation has come down. Will that keep the Federal Reserve on the sidelines? Obviously, it didn't last week. But not long after the Federal Reserve rate hike, you got a very benign PCE number, which is their preferred number. For that number was for June. We'll find out a lot in 2 days because we're going to get the July jobs report. So I think all of that spells really good things. I would echo what Phil said about earnings. I know you want to pivot to the bear case, but there are a couple of those things have a lot of buts with them. And the earnings, as we were talking before we went live this morning, a lot of the earnings have some I don't want to say fantasy built into them, but like I was joking before, like you just, especially if you're a technology company, you just say AI and your stock goes up 5% no matter what your earnings were. So, but anyway, all of those things look very, very healthy. The only thing that's kind of holding everything back is the inverted yield curve we already talked about.
Yeah, before we get to the bearish case, I want to kind of add to this, just from the technical side, is that a bullish market leads to more of a bullish market, and that the trends tend to extend, right? So if you have a trend going, especially in the bullish side, and if you think about the dynamics, there wasn't long ago before like 90% of market participants were bearish. It was like strongly bearish with investor sentiment. And then all of a sudden, everyone got 90% were bullish, like just, not instantly, but very quickly. And that has caused the market to rise rather quickly this year. And when you have that kind of a bullish sentiment, it tends to lead to short covering. It tends to lead to rapidly rising markets and all these other things. So that tends to perpetuate much longer than it should, right? As this old saying goes, markets can remain irrational longer than you can remain solvent. And the reality is, if you're short in the market, then you can get your hat handed to you rather quickly. So I think that is also part of the bullish case, and that is not a rational argument. That is a psychology of markets kind of conversation, which is, hey, the market's going up, means it probably can continue going up. It may turn, like we may be at one of those inflection points now, who knows, but very easily it could keep going up, which regardless of what you think about the economy, and we'll get into the bearish case in a minute, you have to concede that the market can go up even if things are terrible. Look at 2009, 2010, 11, 2020. You look at all these moments where economically things are terrible, and yet markets keep climbing. Of course, after they drop, but they climb. And look at 2020. There's no reason that we should have had a market that was positive for the year when the entire world is stuck in their home and they can't work. No reason for that, but yet it happened, right? And so you can't expect that the markets are going to be rational and that your opinion of the world, which may be correct, is going to align with the stock market. So I just want to throw that in there because I think most people overlook that point, but it's really important. So Phil, let's talk about the bearish case. What are some points in the bearish case here?
Well, we talked about the inverted yield curve. So that's certainly one, because historically that's been a precursor to a recession. We have the fact that we still have some inflation higher than the Fed's target, which means that the Fed could continue to raise rates. And if the Fed continues to raise rates, that's going to have a negative impact on growth, because as money gets more expensive, it's harder to finance the projects that lead to growth. So like those are the two biggest things that I see out there. And then, you know, as I talked about or mentioned before during the interview, we talked about that wealth to income ratio. He said it was 760, and historically, like, it hangs around 550. So if you take that as being a meaningful indicator, in the past, it's led to, you know, a negative market. So that could be another factor. So there's definitely some things there, but it feels like the positives outweigh the negatives right now. And, you know, the thing that, to tie back into what you just said, Kirk, I mean, that's just momentum. A lot of that's momentum, right? The momentum often carries the market, and that's the psychology. So a rising market, everybody wants to participate. And oftentimes the best time is, you know, when you said when 90% bearish, that's often the best time to get in, right? Because that's when everybody's negative and you get ahead of everybody. If you can, it's not easy to time it, but ideally you want to get in when the sentiment is at its worst, because then you get the full benefit when it goes in the other direction.
Yeah. Okay, great. Tim, what about you? What are some of the bearish thoughts in your mind?
Yeah, I mean the bearish things that go through my mind. Obviously, I'm a big believer that the Federal Reserve has more sway over the financial markets than anybody else. I to me, and I think we're doing this. I make a distinction between a bear case for the economy versus a bear case for the stock market. Because I think you made a very good point there, Kirk. And Phil, you stole the word right out of my mouth. You guys know I'm a big factor investor. And as soon as we talk about like market going up and can keep going up, to me, that's just momentum. That's why that factor works, and why it's one of the most robust out there. But um, you know, a crappy economy does not have to mean a crappy stock market. And I get asked the question all the time, like, we're going into a recession, shouldn't we be getting out of stocks? And you can go back to like 1970, and if you run annual correlations between U.S. GDP growth and S&P 500 returns, the correlation between the two is somewhere around 0.09. It's very rare to find a zero correlation, but 0.09 is pretty darn close. So I think the bear case for the economy is readily available. You know, and it's funny because the bear case for the economy the bull case for the economy is the bear case for the economy, meaning the economy continues to stay strong. If we get a really low unemployment number, if we added more jobs in July than we thought we did, and wage growth is higher, then the Fed is right back in play again. You know, it's funny. Every time the Federal Reserve comes out and talks, you know, and the market reacts, I'm like, wait, what was everybody expecting? Like the Federal Reserve is not viewing the world the way we are, you know. And when I say we, I mean investors in general, because I'm kind of more in the Fed's camp of like, I don't know what you thought was going to happen. The Federal Reserve never said they were done. They did say two more hikes, but so in any event, I won't ramble too much. But the one thing I was going to add there was, even if you wind up with the bear case on the economy, which is the economy stays hot, which doesn't sound like a bear case, but if it stays hot, the Federal Reserve could do more to break it quickly. That's my concern about a bear market, is not that we gradually slide into a negative GDP or a recession or whatever. My concern is more that the economy continues to stay hot and the Federal Reserve remains committed to breaking it, and it winds up being a snap as opposed to a long glide down. But even if you do continue to get a rally, I bring that point up that you just made, Kirk, all the time about 2020, because I got into it with a friend of mine who was saying at the end of the year that stocks were too expensive. And I kept saying, well, which stocks? Right. I mean, energy stocks were down 35% in 2020, and technology stocks were up 43%. So it was certainly not like a broad-based market move, but you're right, Kirk, because everybody looks at it and goes, well, the S&P 500 was up 16%. That's because of seven stocks. The other 493 got hammered. So I do think those are important distinctions that just kind of bringing that full circle. Like a bear case for the economy does not have to be a bear case for the stock market, although the stock market has certainly run enough that people could be looking for excuses.
Yeah, I couldn't agree more. And I'm sharing the data that we had talked about earlier with the debt to GDP for countries. And if you look here, this is through the economists, the global debt clock. So if you look at the United States, we have 93% debt, public debt to GDP. Canada is 85. Australia is 27. Brazil is 55. China is 17. Japan is 261. Now, I point this out just for relative. Here's Spain for 91. Here's France for 102. Here's Germany for 85. So even though Germany may be a AAA rated company, their public debt to GDP is quite high. Now look at Russia, 8% of public debt to GDP. That is really low. Look at Saudi Arabia's 14. Iran is 15. So in comparison, I find it really comical that if you look at some of the countries that we deem as enemies actually have low debt to GDP, not all of them, because China's pretty low at 17, but India is 54. So if you look at the developed world, a lot of people have high debt to GDP. And I just mention it just because it's really important to distinguish that this may mean nothing. And it may mean nothing for a long period of time because we can keep printing money. We can keep the game going because that's their job, is to keep the game going, keep musical chairs going until things implode and then it's too late. But for now, they're going to keep the game going. I also want to share one other index that I always love, which is called the Big Mac Index, which is basically the value of the dollar globally. And it just shows how other countries are in comparison. So you mentioned the Swiss country. They have a very expensive currency in comparison to the dollar. We also have Norway, Norwegian krone. So Norway's always up there. You've got the Danish and the Swedish. So all those countries you mentioned, AAA, are more expensive than dollar, and probably rightfully so. And you go down here and you see some other countries and they're a discount. But I just want to share that because I always find that stuff interesting in respect to how the U.S. is doing. So I also wanted to kind of pull one up on the conversation about the bearish case. Because I think the comments you guys both made about the Fed are very accurate. The Fed has been saying for the last few years that they're going to raise interest rates and they're going to squash inflation. That has been their goal. And, Powell doesn't want to be Burns. He wants to be Volcker and he wants to squash it. And if he keeps rates higher, my proposition has always been rates are going to be higher longer than anybody thinks. And I don't think he's been shy at advertising that. He's been talking about this for years. We're going to keep rates high. We're going to keep raising them. And people are like, yeah, you're going to drop them in like 3 months. That's what the market is saying. You're going to drop it in 3 months. Yet it's a year later, and they're still not going to drop it in 3 months. Every 3 months, it's going to be another 3 months, another 3 months. And the way that we shared this on Friday on our episode live that actually is coming out today, we talked about this on how if you see what's priced in is, I think, the end of the year. And no one's predicting higher rates than we have now. Well, Powell even said we might go one more. I personally don't think they'll go another one. Maybe they do if the markets just keep skyrocketing. But in general, why should they lower them? There's no reason for them to lower rates, except if we have inflation that gets into the really low, meaning zero or negative territory, then it's a question of what's more important. Is it more important to keep rates? Let's say the stock market's doing great and we have rates at 5.5% right now, and the stock market's doing great and inflation's at zero, hypothetically. Then what do? They're going to lower rates? That would be ridiculous. Why would they lower rates? You don't need to. Yet that is a conversation that needs to happen. So I think there's a lot of dynamics coming in here that aren't necessarily bearish, but are interesting. But the bearish case, it's funny because the bearish case is basically we've been bearish and we feel like we should still be bearish. I'm not a permabull, and I'm certainly not super bullish here because I think the stock market is very expensive, as are all assets from what we've seen.
We deal with a lot of alternative assets with real estate and other things. Across the board, everything I'm seeing, with exception maybe some parts of farmland, although farmland, people are finding it difficult to find good deals. But outside of that, real estate, across the board, other assets, everything we're seeing is super expensive. And so people are calling us saying, hey, we want alternatives. I'm like, I'll put you on the list. But right now, there's nothing there. And I hate turning away new clients, and I hate turning away business, but it's like it's the right thing to do. There is nothing out there that is reasonably priced on our side. Now, we're fully aware that like when things turn, we're prepared to dive in with both feet. So like we're just like, yeah, we'll keep you on the list, but nothing we can do for you at the moment. There will be a time where that will change, and it's inevitable, right? You have high interest rates, real estate's eventually gonna drop from where it is, because it shouldn't be where it is, in my opinion. It's super bearish for real estate. But the rest of the economy seems to be fine. Big tech, they seem to be fine. They just cut a lot of jobs. They're cutting expenses. So whatever they had before, now their expenses, so they're more profitable. And this isn't every company, because we just had Yellow Trucking go under a few days ago, and that's a problem. So let's talk about that. Trucking, like, why is a trucking company going under? Have you guys followed this at all?
I mean, I think it was primarily, I didn't follow it too closely, so I don't want to get over my skis, but I thought it had a lot to do with like employee shortages and inflated costs. And that's actually, I don't know, Phil, you might contradict what I just said, but I was going to bring that back to, that's one of my concerns now, is you're seeing oil and gas prices start to spike again. And I think people forget that those find their way into the inflation numbers. So before we get too excited, and by the way, I don't know if you can see it or share it, Kirk, but I sent you a dot plot, which basically shows like everybody's expectations about what the Federal Reserve is going to do. And it took a couple of smacks in the head from the Fed for people to have all these expectations of, you can see where everybody expected Fed to go in 2022. And then 2023 and 2024, I think everybody got the message like, yeah, okay, rates are moving higher. But yeah, so you can see in 2022, everybody was expecting the Federal Reserve to pause and start to cut earlier. And then now in 2023, and even still hanging on into 2024, the expectations are still not nearly as benign as they were back in 2022. But sorry, I doubled back on a point just because I sent that to you, and I think the dot plot's important in terms of people trying to finally get the message on what the Fed's going to do. But Phil, did you have any more info on yellow?
I don't have a lot of information on that, but I know, because I used to be an analyst covering oil and gas stocks, like that definitely does have an inflationary impact. And like if you look at those prices, we were just in Italy and we rented a car, and then like the price of gas in Italy was insane. I mean, it was like it was over €7 a gallon for gas. And if you use the exchange rate,
not a gallon, like a liter, right?
Well, no, it was when I translated, it was like $1. It was like 180 something a liter. Oh, so that would translate to over $7 a gallon, like €7 a gallon, which is more closer to $8 a gallon. And you think about our prices, like where I am, they're a little bit less than half of that. And and you have to remember, it's not just the gas that goes into our cars that oil affects. It affects plastics, it affects petrochemicals, it affects so many things. So it definitely does have an inflationary impact when oil prices go up.
Yeah, and a lot of people are talking about how oil prices are going to start to go up. I'm not. It looks like they spiked a little bit from 70 to 80. It's down today, but we've been talking about in the show. We had a few people on, a few guests that are experts in oil and gas, and even they said we've been under investing in infrastructure for pretty much the whole Biden administration, since they're down on oil and gas, and so they haven't been investing. They're just not reinvesting in capex, and so their earnings look better, but ultimately it's going to hurt them in the long term. So I'm very interested to see where that trend goes.
And the other thing that happened with that, Kirk, is like if I think back to when I was an analyst and the companies were going crazy on their capex and putting so much into it, and the market kind of changed the direction a lot of those companies went were going in, so that they made them focus more on their free cash flow. And so if you start to focus more on free cash flow, you're going to spend less on CapEx, because free cash flow is basically your cash from operations less your CapEx. So if you're trying to increase your free cash flow, you're going to spend less on CapEx. And so it becomes a problem that can easily mushroom because of the fact that so many oil projects, it takes years. It's not, I mean, the shale oil is pretty quick, but a lot of those offshore projects and some of the other projects, they take a lot longer to produce oil. And so when that happens, when you underinvest, there's a long-term impact on that. It's not like it's a short-term impact, and you can't just turn it around quickly.
Okay. So we got a limited time here. We're going to wrap it up. So I want to ask for final thoughts from each of you. And ideally, maybe if you can throw in there when you predict, which of course we know in the show, predicting is like astrology. But when you predict, or let me give it a different way. What do you think will cause a recession in this country moving forward? And then maybe you can wrap it up. Do you want to go first, Phil?
I'm definitely not comfortable making predictions, but I mean, I certainly, I am definitely concerned about interest rates if the Fed continues to raise. I mean, like Tim showed on that graphic, the view on interest rates has changed. And if the economy stays too hot, that does raise the risk that rates continue to grow. So like, that's the biggest thing I think that I'm paying attention to right now is probably going to be interest rates.
Okay. All right. Where can people find more about you, Phil?
So my firm is Apprise Wealth Management. I blog every week. You can sign up for my blog if you go to my website. You can also go to apprisewealth.com/ebook and download my free ebook. And at Apprise Wealth, you can sign up for my blog as well.
Awesome. Tim, thoughts from you, recession, and final thoughts?
Yeah. So my final thought would just be, and Phil addressed it earlier, but you look at something like a downgrade, and the S&P 500 is down 1.25% today. NASDAQ is down over 2%. Why does that have such an outsized effect on technology and tech-related stocks? Who knows? Maybe it's just because the NASDAQ is crushing the S&P 500 this year. Does a government downgrade affect Facebook more than it does Ford? I don't know. Doesn't really seem like it does. But we try and get everybody to focus less on the noise and more on what matters to you. If you own stock, you own a piece of earnings. The thing that should matter is earnings, and you've had over 80% of S&P 500 companies beat earnings expectations this quarter, which I think we've all talked about expectations and how much they're worth. Expectations and $2 will get you on the New York subway. But still, it's been a strong earnings season, and that's what should matter to stock investors. As far as a recession, I mean, they're difficult to predict. My comment, as I made earlier, if I was going to make a prediction, which is dicey at best, I'm not sure we're going to go into one because they're, like I say, I mean, in 2021, we went into one, and the National Bureau of Economic Research never even called it one. Because if you have a jobs market that's still pretty robust, just because you have negative GDP growth, which we do not seem to be on that trend, as Phil mentioned earlier, it's nobody's going to actually call it a recession because people still have money to spend. So my prediction, lame as it is that we're not going to go into another recession, not in 2023 anyway. And just for anybody that wants to learn more about what we do or what we're thinking, we're at metricfin.com. So metric financial without the anchal.com. And we've got a whole bunch of educational material up there.
Awesome. Well, I really appreciate both of you coming on the show and sharing your wisdom with us, and we'll definitely have you guys back on. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do.
So invest in your life.